Hello and welcome to Upside, where every week we look behind the headlines affecting European venture. Today, Lomax, myself, and we have a very special guest, and I'm going to do a pig's ear of introducing him, but I'm going to give it a go anyway. He's a very accomplished man. Our guest today is founder. He's got his PhD in chemistry at Bristol, knows a thing or two about synthetic molecules, sold his company Xylo to Novo Nordisk for 800 million. Then he built his own incubator, Science Create, active in UKRI, runs a STEM charity for kids, founder of SCVC, currently raising 100 million second fund, Chemistry World Entrepreneur of the Year, openly dyslexic, ADHD, and super fabulous, Dr. Harry Destecroix. What? Round of applause, please. So today we're talking about physical AI gets its SoftBank moment, the AI token economy, looking at the Chinese. Europe finally writes a big check. Cursor gets caught out. Innovate UK gets a founder. A new item this week, we're going to try and dig into some predictions and deals of the week. Thank you for joining us. I'm gonna no doubt pick your brains quite a lot on these topics. Now, starting at the top, we're going to talk about EIF's 15 billion euro fund of funds. The title that I've given this, just to tee it up, gents, is Europe finally writes a big check, but is it the right check? Now, we all know there's a funding gap in Europe. We need this here. By some measures, we're about $75 billion off the US by quantum, although I'm not sure where that number really comes from or even why we're comparing. The EIF is launching this $15 billion fund of funds to back 100 growth stage VCs, and it's looking for mid-size, the 300 to 600 mil, and some mega funds, the 1 bill plus. And they're looking for a first close this summer. I've read it's going to be probably Q3, which to me means that they don't have all the LPs signed. So maybe there's some pensions and institutions that aren't in the pot just yet. They are looking to use this 15 bill to unlock 80 bill in scale-up funding, which obviously we desperately need. Now, the way that I'm reading this is simply the EU's push for sovereignty and therefore defense, which I think is fair enough. Will it drive? So here's the questions that I want to kind of throw into the room. Is this going to diversify the ecosystem or just entrench the incumbents that they've been serving? Does that even matter? Thinking more geopolitically, and we're going to talk a bit more about these topics later. China's strategy is open source, and they're now looking to sell tokens and create a token economy. The US obviously has the foundationals, the RIAs, the big mega funds. Europe, I've put in the bracket of we should double down on the application layer. So this new EIF fund of funds model, could it work? Is it a good idea? Do we need more? Where are the pitfalls? Lomax, set more of the scene for us.
Well, let's put this in context here. There is no doubt in my mind, and I think probably you guys would agree, that the quality of founders and talent in tech companies has never been better in Europe than it is today. We don't lack that. We talked about academic institutions before.
I don't think we've ever lacked that. My take is they just haven't been as in the forefront. The boys and girls have always been here. We've always had, from the numbers, more R&D, more scientists, more founders than the US. They just haven't had the showcase. So my take is they're starting to come through. And as we spoke about last week, 25% of the unicorns last year were European. So it feels like they were here. They just weren't front of house.
You know, I think historically we've had a bit of a mindset problem. It's just that, the best graduates have gone to, what someone once called the Bermuda Triangle of, law, accountancy and consultancy.
Fair. Yeah.
And that's slowly starting to shift. I mean, clearly that's also happens in the US, but I think the US has certainly a more entrepreneurial mindset where going into an entrepreneurial profession rather than selling your own business is more celebrated in society. And I think that slowly is changing here. But the major constraint we've had is capital, right? So, to put it in context, the EU and the UK venture raised roughly $60 billion in 2025. Then, the number in the US was $340 billion. The OpenAI raised a round of $40 billion at the beginning of last year. I think their next round is mooted to be 60 to 100 billion.
Well, they just did a little mini top up of 10 bill, just a cool drop,
and
10 bill, right?
Raised 30, and Anduril's about to raise 60. And that's just the whole market last year in Europe. So the big problem is capital. And this is a great thing. The other bit of context is Europe lacks capital at the sort of growth stage. We have actually a lot of pre-seed and seed capital now in Europe, but there's 5 times the number of rounds of between 20 and 100 million US than there is in Europe. So what the EIF here, the European Investment Fund, is saying is we are now creating a big fund of funds to try and focus on the growth funds that can write these bigger checks. So I think that is undoubtedly a really good thing. The other context still is that to plug the capital gap, we still rely a lot on government money in European venture. It's still something like 40% of the capital raised by European venture funds, including the UK, comes from the big five: EIF, British Business Bank, BPI in France, IFO in Denmark, and KfW in Germany.
But you mustn't dismiss the American subsidies. The American government has subsidized private and public markets for decades.
Well,
That's what their deficit is. I mean,
Well,
if you just
yes, I don't disagree with that, but the same thing happens in Europe as well, right, to a certain extent. But when you look at this in this particular like direct capital intervention, Europe is much more underpinned by government money than it is in the US
I
because
think there is a problem there. I think sometimes it's great that they do it, but sometimes the inflexibility they put on venture funds, you do get this kind of monolithic business model because they say this is how big your venture fund should be, this is how you should deploy it. And the one thing I think Europe does lack as well is that there's less diversity within these different bands of VC funds, and that's because it's almost like it's a grant competition to raise a fund in Europe sometimes. So it'd be great to see more flexibility in these things.
It has flexed, Harry. I'm on the inside with some of the European outfits and the BBB quite heavily, and the whole Trump, Russia, Ukraine, Gaza, Israel, and the whole onshoring, reshoring, friendshoring, defense resilience push has really made them change their minds on lots of things.
Yeah, I mean, I am hearing it, with BBB, but I'm not seeing it at the moment. I've seen it in the top line strategy. I mean, I think the big problem is, you've said it, there's amazing founders, amazing research, but actually pre-seed and seed funds are far too small. And at the end of the day, your fund size is your strategy. And if you look at Europe, you've got so many sub 50 million funds, and there's hardly any 250. And then you get these mega funds. Actually, I think the big problem we have is that typically, US founders are raising, almost Series A level of capital up to seed. They're getting this kind of 10, 20 million seed. And then effectively, what you then have is sort of multiple rounds of dilution, and you get into this issue of messed up cap tables. And then you've got this problem that, US funds don't want to come into some of these deals. What's great to see here is there is this kind of mention that it's not like the previous one going to these kind of mega billion plus funds. There is this kind of 300 to 600. What I hope for those funds is be a 300 million seed fund. Why not fund things properly from day one?
But the argument was always, wasn't it, Harry, that there weren't enough startups to fund. So your thesis is there are now enough businesses to fund.
I don't know. I think there's definitely enough businesses. I think they're just, in the UK, it's terrible. But outside the Golden Triangle, these kind of size of these average pre-seed seed funds falls off a cliff. It's like hundreds of thousands.
Yeah.
So it's a massive problem. But we need to, the companies are there, but if you funded them poorly, the company is then continually fundraising. It can't bring in the talent, and it can't achieve kind of the technical progress in the US counterpart. So the science has always been there. I think we've just chronically underfunded at the early stage.
That's actually a really good point, Harry. And one thing, it reminds me of this notion that the goalpost keeps moving. And so we actually, at one point, we did have a major problem with pre-seed and seed in Europe. Then we actually largely fixed that, because a lot of the big five that I just talked about have, outside of this major program that we just talked about, have put a lot of money into anchoring seed funds, right? The $50 to $60 million seed funds. And that actually meant there was quite a lot of good capital for the 1 to 3 mil seed round, pre-seed and seed round. Then we talked about this problem, later stage capital, which they're now trying to fix. They've now got to put a finger in another hole, which is basically that the market has moved such that good companies don't want or need a 3 mil to compete globally. A 3 mil seed round doesn't cut it anymore.
No.
They now need to raise 10 mil seed round, which means you need to go, you fix the seed round.
ECF has a 5 million max round size still. I mean, I've said this before.
Still.
Hopefully they're going to waiver it. But, so you say, company wants to raise a 5 million plus pre-seed, seed round, whatever you want to call it, right? Their first round.
I don't even know what these names mean anymore.
But you go look at the best companies, they're raising, easy 10, 20 million on
Out
some
the
of them
gate.
are raising 1 billion seeds. So like, we're orders of magnitude sometimes away from where it should, and especially that the pendulum swing into physical AI to deep tech. There's early technical risk that needs to be hit on top of just your MVP and showing product market fit. So here it's especially important that we capitalize things properly from day one. The other thing that happens if you undercapitalize early founders, they get into bad habits, they get bad advice, they can't quite get the talents. These problems compound and they elongate the journey and just add risk. So I think you're actually better off funding things
So, Harry, is
properly.
your thesis that whole kind of being constrained by capital because of AI, because of defense and resilience and the new quantums that we're talking about, we just need to, I guess I'm answering my own question, we just need to think very differently about the pot of time and the facility that the money is going to enable for these founders, and just maybe just double everything, I guess.
We just need to look across the stack, right? If you've got multi-billion huge growth funds, you've just got to think that you've got to put more money in at the start, more money at the middle, more money at the end. And I think you'll get higher quality out the other end. The problem is all of a sudden you've got too many big funds. You're still in this situation where you've had underfunded companies at seed. And then you're going, well, hang on a minute. If I go compare a Series A in the US and compared to Europe, they've done a lot. Of course, they've done a lot less. They've had a quarter of the capital. So you've got to. I constantly hear that there's no problem at pre-seed and seed. There is, absolutely is, and that's because our funds are far too small. Which means if you've got a 50 million fund, which is probably a big seed fund in Europe, you cut that up 20 ways, maybe 30 ways. You do, half on an initial check, reserve half for follow-on. All of a sudden you've got these party syndicated rounds, horrible syndicated rounds. This means it's just a headache for founders.
But we can't compare. We can't compare. I mean, you can't, if you look at the RIAs and the big mega funds in the States, there's just two different strands of venture. But they're not even VC. So it's hard when you're having a venture capital bucket conversation when really there's maybe 2 or 3 different models that we're aggregating together. I don't know where the lines are. I do believe, though, to my last point in my tee up, that Europe doubling down on growth for the application layer. Let's worry about America doing all the foundational models and all the big ticket stuff, if you like. China, we're going to talk about later, which is their new AI token economy. I don't know if it's going to take off or not, but I think it's a really interesting model that they can apply that other markets can't. Maybe Europe should do what it does and just focus in on defense, resilience, sovereign, but the application layer of AI rather than worrying about what is demanding mega massive tickets. I don't know. That's my thesis.
I would agree that we shouldn't be going after like mega foundation models and things. I mean, we can't compete on costs of electricity, but in terms of like the hard tech, the deep tech, which is the physical picks and shovels of this stuff, the collecting of the data, that still needs, advanced manufacturing. You still need deep pockets. And that's where I think, and what's good to see with this EIF money is it is focused towards these areas. It's not just building mega bio AI foundational models and data centers. It is going into that kind of like hard tech, deep tech space. And that does need decent amounts of capital. Not these kind of £1 billion seed rounds because you're building a foundation model. And I think we should be more on the picks and shovels and the applications. I completely agree.
Yeah. Lomax, sorry, we very rudely interrupted you through all of that.
No, nothing. I mean, I think it's funny. Harry's raised a really interesting point. Like I keep going on about, and here I was making the point that we do have a massive gap at the growth stage, particularly in deep tech companies, where they really should be raising to be globally competitive from 100 to 200 million at Series B, Series C, and especially if they're deep tech, where the metrics that you use are different to an application layer company. They can be very, very difficult to get the big checks that in the US people like Founders Fund, 8VC are very, very happy to write. I think it's good.
But don't you think the sovereign side is gonna soften that a bit? And what I mean is
what I'm saying. No. I'm saying that if you look at the text on this EIF $15 billion 15 billion euro fund of fund when it's eventually raised, because as you say, it's only been committed on 1.5 so far, is they want to be backing funds that actually cut 200 million euro checks into a single round, right? So that does mean it's not going to fix the problem that Harry just articulated well, which is that actually, unlike what I was saying, we do have a problem at pre-seed and seed, which is we're not getting round big enough. And that is a very good point. But at least it's starting to fix this kind of later stage problem where actually deep tech companies that want to go, and I have a number in my portfolio that should really be trying to raise between 50 and between 100 and 200 now, but they can actually only get 30 to 50. I think that's something that we really, really need for these companies. Otherwise, they're either going to get acquired or they're going to be moving too slowly. They won't have the velocity that they need to hire.
But it will displace some of the American capital on it. I think that's part of their point, is that if we can fill the gap and retain ownership for longer, then obviously some of that value stays in Europe.
Maybe, but it puts us on more of a level playing field. But remember, the American capital is like deeply competitive, right? Remember the 11 Labs Series A, I think A16Z got into that round under the noses all the London VCs, right? By flying in overnight, actually being one of the few VCs to have actually tested the frigging product. I mean, the bar is actually quite low, isn't it? But
yeah, let's not use that as an example.
Don't forget the don't quote me on this, but I'm pretty sure EIF make the VCs, make the founders sign frigging side letters and things that they can't do this and they can't do that. Like that actually makes you not that competitive as a VC. I mean, we had a round with an EIF fund the other day where from term sheet to closing, it was like 4 months because we were frigging about trying to make sure that the round was compliant.
This is another part of this problem with the FO. Let's say the fund of funds, this 15 bill gets closed over the summer. Let's just say that it will happen. How long will it take for that capital to hit a startup's bank account? 3 years? 5 years?
Yeah, I mean, it's very funny having chatted to
or
someone.
Or do you assume it's deployed over 4 years?
I don't know. I imagine there'll be a 4-year cycle, right? And also this has got to go through all their approvals to be closed, to then fund of funds approval to close.
But you know what? To be honest, then this is, also touching on Harry's point, there's only actually a certain number of names in Europe that can absorb this capital. So it is going to the same people over and over again, which actually you could argue, even though there's some very good actors in our ecosystem and some great funds there are some also kind of like it perpetuates any problems that we have in the ecosystem because it's the same people receiving the same money every single time, right? It goes back to Harry's grant competition. Who wins the grants? It's like maybe sometimes the people who are better at, getting grants.
Why give it to one fund of funds? Like, why not have a couple of fund of funds so you can actually, with slightly different strategies at different areas? I think it's also,
maybe. I mean, maybe there will be some kind of micro fund of funds or other niche strategy fund of funds that live underneath this bucket. I don't know what their strategy is. I mean, they've explicitly said the mid tiers and the megas. That's what we're trying to build. So maybe.
I think it's good that the mid tiers are coming. Your point, I don't think we're always competing with capital from America. I think a lot just doesn't raise. So I think this, it's not always the case that, like you said, there's probably companies that can't get the capital from Europe, can't get the capital from America, who now can, we'll have more shots on goals.
Guys, any other final thoughts or insights on this before we move on to the Prometheus project?
The final one I'd say is the holy grail really here is actually for the governments to not be involved in this process at all. It's probably better for the governments because it frees up the capital for elsewhere. And you have this gap is filled by private money, which basically is, pension funds, insurance companies, endowments.
Beyond the 15, you mean? Is that which bit are you
first of all,
saying?
That 15 is actually going to be made up of private money as well. It's not all public money. But I'm saying the holy grail in the longer term is that Europe actually develops a private capital base that doesn't come from governments, that actually invests in funds that you have in the US that you don't have here. 0.02% of total assets in EU pension funds are invested in venture capital.
They've got to get in, haven't they? The pensions, the banks, the insurance companies.
The difference. It's very, that for me is the long-term solution. Is you then that private money, you don't have to go through what Harry calls these grant competitions. You don't have to have all the strings attached to government money. You don't have a bunch of people trying to hold you to account in Brussels. I think this is a much cleaner, smarter system, but it's going to take a long time. And we've talked about it here with the Mansion House Accords, governments trying to get more of this private pension money into venture.
And of course, we've got the setback this week as well with Mansion House, where the House of Lords just voted to strip the government's sort of power to push this on. So this is a huge setback. If you read the FT and what they think about this, they're saying this is too risky for It's not. We're talking about a 5% allocation. If that goes down to zero, which is probably not gonna do, of that, it's less than 1% that will probably end up in VCs. 1% of your portfolio construction or 5% of your portfolio construction. It's just crazy just how this risk is absolutely blown out of proportion.
Totally misunderstood.
Anybody should have 5% of their portfolio in high risk assets. Anybody. Obviously mine's way higher than that, but
I was going to say mine's 95 that way, I think.
But
there you go.
But it's it's all about weighting, when in portfolio construction, and if less than 10% is in a high risk situation, of which it could disrupt that 90%, which is what Europe's seen over the last 2 decades for not being in these things. When will they learn?
It's not. They can see how it works. Like, why don't we just look across the globe and take all the best bits and apply that thinking?
And the British hate anyone who makes money. That's one of the big difference between us and the US, right? Is like we hide our money. He's got the classic kind of wealthy Bristol individual that pretends to be poor, yet he's bought his house from a trust. It's a very British thing, isn't it?
Yeah, it's a very cultural thing.
So whereas in America we celebrate success.
I want to move on. I want to talk about that Bezos has launched his 100 billion project Prometheus. The title I've given this is Physical AI Gets Its SoftBank Moment. So Jeff Bezos, Amazon fame, is raising 100 billion for a fund that isn't a venture model. What he's doing is he's buying up, well, this is the plan, there's nothing has happened yet, buy up companies in major industrial sectors and modernize them with AI. So Prometheus is the Greek mythology, is the Titan who created humanity and then stole fire for them. This isn't venture, this is the PEification of physical AI in my world. Now, I've always loved the idea of doing roll-ups, and I think this is an incredibly timely, strong strategy. They're going to design the playbook for manufacturing, buy up the companies, and then apply the playbook and the tech. It's buyout meets digital transformation at a scale we've never seen. Does it validate the category or swallow it or jiggle it in some other ways? Incidentally, the SoftBank Vision Fund is the only private vehicle to ever raise that much cash. And that was heavily reliant on the Middle East, which may or may not be doing stuff right now, yet to be seen. But this is a massive chunk of change. What do we think of Bezos's 100 billion project Prometheus? Who wants to kick this one off? Lomaxius, go for it.
So, I mean, the SoftBank moment without Massa instead of switch out Massa, switch in Bezos. No, I probably, for this kind of thing, I probably would have Bezos on the bench. So look, as a reminder to set the context here, Bezos raised a $6.2 billion seed round for Project Prometheus at the end of last year, which is a startup, which he raised with Vic Bajaj, who was a chemist and physicist formerly of Google X and co-founder of AI incubator Foresight Labs. That is a startup working on AI for the physical economy. So in a way, like what Anthropic is to, what Anthropic and LLMs and OpenAI are to the knowledge economy and to software, and to knowledge work, to law, etc. This is to factories manufacturing, to the physical world. The sort of second part of this is that he's now looking to raise 100 billion to roll up old economy manufacturing companies and probably plug Project Prometheus into, or the Prometheus startup into these
where
companies.
There's no margin, right? They're looking behind the scenes. You're looking at a lot of the companies that they're looking to buy on the strategy. They're really tight margins. They're really, really hard businesses because they're so antiquated, I think is the
and
core
this
of
is, the market, just to step back, the market here is scarily big. So, the information economy, which LLMs touch, right? The software world is touching roughly $20 trillion of global GDP, which is, just under 20% of global GDP. Like the physical economy is like all the rest. So that's like 80 to 90 trillion dollars of global GDP. Industries like that have been untouched by software for years. So I think it's hugely exciting. It's a massive big swing. He's, probably raising money in the Middle East is not as easy as he thinks at the moment, right? But ignoring that aside, this is an exciting project. You would never bet against Jeff Bezos. There is so much to go out here. We've talked about physical AI a lot on this pod, but I think we're only at the beginning of this. And this is actually quite relevant for Europe for a few reasons. So one is that Europe does actually have amazing research and talent in robotics. Obviously, we know in AI too. Europe is stacked with legacy manufacturing companies. Something like 20% of European GDP is manufacturing, whereas it's only 10% in the US. Europe has an aging workforce, shocking labor laws, and at the moment, there are no homegrown champions in this area. We talked about actually all of the robotics companies in Europe being sold off to elsewhere. So actually, there is a huge opportunity. I don't know where Bezos's deployment of this fund would be. Probably a lot of it in the US, quite frankly, because he doesn't want to get involved in all of the issues that will happen in Europe. But certainly, as it applied to Europe, this would have huge impact.
I think going to be a good thing for the tech side, which is obviously going to need to be brought into this mix, as well as kind of modernizing some of these factories. I think it's interesting on the kind of political side. Like, I would have thought there would have been way more doomers on this for Europe. I think just everyone's so focused on Iran at the moment. I think it's just not really hit the top of the headlines. So I think it's just, but I'm sure we'll probably see, some of the fears of this kind of going after kind of these manufacturing jobs. But at the end of the day, hopefully we can attract some of this capital to Europe, because if it doesn't modernize, then it's going to be done elsewhere. So you've got to, this has got to happen in Europe, because otherwise they're just going to be displaced completely. So what's worse, that this all gets done in America or China, or Europe gets this kind of opportunity. And then of course for us VCs, hey, this is potential liquidity. So I think overall this is a positive thing, and it's validating just what we all believe, the size of this kind of physical, not just the bits, kind of opportunity with technology kind of slowly creeping in.
Loving it. It's funny how everything is now moving into the real world. Love it.
It's funny.
A couple of decades.
The only question I sort of that will time will tell, and this is an age-old question in tech, is: do you take 100 billion? Do you buy a bunch of old economy manufacturing companies and juice them with AI and robotics, or do you just start from scratch and go like, we're going to build the Airbus of the future? We're going to build, you know what I mean? The defense company, we're going to build the Rheinmetall of the future.
It's got to be that. It's the only way to scale is that, right? It's got to be that. I can't see any other way of doing this strategy unless there is absolute, this is how we build tanks. This is how we build taps. I don't know what the things are, but I think this is going to be,
he seems to be going
the
former route. He seems to be buying incumbents and juicing them rather than actually going greenfield and from scratch.
Maybe it's simpler just to get around EU's planning laws. I mean, the fact is, they probably own the property, right? I mean, it's just a way to say, here's a factory next to a train line.
They have IP, they have everything. It's just like
brand. Maybe it's you've got the brand, you've got the physical location, and then you just put rebuild the whole thing with that. And I think that's what the plan is. I think it is to take in their full stack, right? So maybe it's a way of both of those things happening simultaneously.
But also very complicated.
That can happen quicker.
If you've got like a certified thing like an aircraft, if you fundamentally rip out and change the manufacturing process, you almost have to like recertify the thing anyway. Sometimes I wonder, you're better off just starting from scratch. But look, I mean, these are smart people who can figure it out, and but I'm sure time will tell. And that there are full stack companies going after new. I mean, look at Helsing. I know Helsing is doing some M&A, but they're going after, the defense sector in Europe, like from scratch.
I want to talk about another model. So Bezos is bringing here is that the Chinese are bringing their AI token economy to market. So the way that I've described this in the descriptor is a new OPEC measured in tokens, not barrels. So China has formally adopted the I'm going to say this wrong, excuse me, Chinese people, C-yuan, as the Mandarin term for token at the 2026 China Development Forum. And what they're doing is they're signaling the state of token-based AI economies. Now, this isn't crypto tokens, by the way, before people think this is some kind of crypto-ish thing. This isn't. This is about selling inference at scale. Because they own the whole stack, they own energy up all the way through. And because of the way that the country is run, they can effectively sell inference as a service. Now, Chinese models are priced at about 0.02 cents per million tokens, which is about 1/180th of the OpenAI price. The Chinese models occupy 4 of the top 5 positions on OpenRouter globally, accounting for nearly 86% of the total. So they're pushing this inference cost race to zero, which I think is something they can do because they own the whole bloody lot. I also think that Cursor has shown the world the way to go. So this week, and we're going to talk about this again in a second, but they're a $50 billion company who chose a 7-week-old Chinese open source model over the US alternatives because it was 8 times cheaper. So we also know that Andreessen, for example, has already shown in some of their data that 80% of startups are using the open source model. So I guess this is a blended way of asking the room, do we believe that buying tokens at scale is possible? Is this something that is not maybe a data or security or other sovereign risk? Do you think this is even possible? Is this a model that we will see come to pass? Maybe Harry, do you want to kick this one off?
Well, where to start?
Yeah, a bit of a mush,
look,
sorry.
it's clearly going to be a part of the mix. People are going to always want, the low cost, cheap solution. So, and especially startups which are undercapitalized, they're going to want to do this, and especially rappers like Cursor who are fighting for better margins. But I think ultimately, if you're building your enterprise app on something, it's these models suffer massive problems of prompt injections and all sorts of issues. So it's security, but it's also reliability. It's great that you can keep switching from these routers, but ultimately, if you want something that's going to be reproducible, you're going to want to have lock in certain models. And of course, you can maybe pick certain models for this. But at the moment, I think we're still in this wanting the best model, wanting the best output is still not quite there. And, for me personally, I'm addicted to Opus. Also, you've got kind of the next kind of Rubin systems coming from NVIDIA. You've got obviously the acquisition of Grok. This is super exciting because you're then seeing kind of, orders of magnitude in terms of what per token. But what I'm massively excited about is this kind of, at the moment, we're stuck at this kind of 200 tokens a second, which is an eternity when you're using this stuff. So, with the Grok acquisition and that being incorporated, we should be seeing kind of token speeds of nearly 2000. And that's going to be really exciting. So it's going to be high quality models, super, super fast. So there'll be certain workloads and certain companies that will prefer very, very low cost and don't mind the speeds. But I think for the real meaty stuff, the real high value stuff, the real, intelligent stuff, you're going to want the top models and you want to have the best speeds in order to kind of solve the hardest problems.
I think I'm not fully with you on the quality and the speed. I think they're not that far behind. It just feels like if you do the 80-20, you're going to get most of the market using some version of this low cost service, whether it's this token economy or other Chinese open source models, whatever it might be. It just feels like a really sensible, smart thing for most businesses to do. Not you, Harry, because you want that level.
Yeah,
but
I think
most
sometimes we're biased because we just want to be using kind of the latest.
We want to geek out, right?
Yeah, and that's the problem when you're kind of an early adopter.
But also, I don't know if you're the CTO of a big healthcare organization, insurance organization. I don't know, well, what's the underlying model here? I don't know if that really works.
Yeah. I mean, look at Microsoft. Microsoft, they've terrible software, but because enterprises use them and, everybody, you get everything bundled in, everyone has to use Copilot.
The only decent stuff they've ever built, apart from, I would argue, Exchange, their initial stuff, they've bought, right? What have they actually built, Microsoft, in decades? All of their good stuff that people like, they bought. I'm being a bit obtuse and rude there, but anyway, I don't want to go off topic. Lomax, what other bits in here would you pick up on?
I think the price of tokens is something maybe at the moment the people in technology know. Fast forward a couple of years, it will be kind of lingua franca on the street. Like everyone will know it. It will be as tokens are becoming a commodity. Tokens are becoming something that everyone will think about because it's almost replacing a kind of unit of manpower, or if you're taking an extreme example, it's becoming the most important thing on the planet, and it will only continue to be that. So this formal adoption by the Chinese of this term token, I think, is a important moment, or it signifies how important these tokens are becoming. As Jensen said recently at GTC, tokens are the new commodity, and he's obviously working, as Harry said, on making sure that NVIDIA is competitive here. But it's, this is the sign of the times, guys. We talked about how the Chinese models are hugely widely adopted. They are going to have challenges, I think, if for Western businesses that want to use them in enterprise, which is obviously a massive, massive market.
If you look at Cursor as an example, obviously they are not, I think, reading behind the headlines. It isn't their Composer 2, which let's talk about now. It was next on the docket, but we can go straight into it. It actually wasn't a full Moonshot AI, Kimi 2.5 ripoff. I think maybe 20, 30% of it was, and they used their own models for the rest. But they have been absolutely hammered for not coming up and saying, look, we built this on the infrastructure on Moonshot's Kimi 2.5. So I think it was the fact that it wasn't open or openly discussed that was the challenge rather than the technology that was used. But doesn't that prove, to your point, Lomax, that this stuff is there and is high enough quality and it is fast enough?
It's definitely fast enough. Is it secure and safe enough? Right, I think is the biggest.
I think you can mitigate that. I think you can mitigate that.
Well, I don't know.
There is this prompt injecting stuff, isn't there, Lomax?
But NIST in the US found that Chinese models are 12 times more susceptible to agent hijacking attacks. So, and this stuff kind of resonates amongst CTOs and in big buying organizations. So look, I personally think, and Thomas Tungens has a really good, always writes well, but has a really good post on this from this week. Actually, this is a really cool thing for startups because, you can use these open source models to build amazing products at a fraction of the price of, you don't have to go and raise 100 million for compute now. So I think that is pretty cool. It might give you an enterprise sales ceiling, but, smart entrepreneurs will find a way around that.
I mean, at the end of the day, once you've built your product and everybody's excited by it, you're just going to run these models in a European or American data center, right?
Exactly,
so
right.
the advantage here is really if you ran the money in China, but you're not going to run them up. If it's a European or an American, they're going to be running a data center in Europe or America. So
yeah.
NVIDIA still wins, or ARM.
Yeah.
Well, yeah. Thank you so much for that beautiful segue there, Harry. So ARM has built its own chip. After 36 years of licensing chip designs, ARM is now building its own. Now, ARM is pretty much a SoftBank company, which I think is semi-problematic. ARM is the UK Cambridge-based firm. I'm pretty sure SoftBank own like 96% of it now. They have released their AGI CPU, which is a production-ready chip built for running inference, which you've spoken about a lot in AI data centers, and Meta is its first customer. I'm pretty sure OpenAI is in there somewhere as well, but I'll have to look that up. So this is a good thing, more inference chip providers. So my question to the room is, how does, to your point, Harry, we don't need, NVIDIA's bringing on its own inference stuff and stock as well, but we don't need, you could run Chinese OS, you can run all these other chipsets from other manufacturers. So how is all this going to wash through? Lomax, do you want to set up some more of the scene on this one?
This is an interesting one. ARM, which has been very, very consistent business model, now is seeing 35-year-old business model being sacrificed on the altar of AI, as one commentator put it. So now they're building their own CPU for inference, jumping on the inference bandwagon. They're like, well, why can't we have a piece of this?
Which is the future, right? Do we still agree that inference is the direction of travel from now?
I think for sure. And this also gets a little bit uncomfortable for ARM because now they're competing with their own licensees, their own customers, right? NVIDIA, Qualcomm, others who pay them royalties. So I think that's something they've clearly managed to get their head around. But, ARM is currently a $4.5 billion business growing at about 20-25% a year, 90%, maybe even 95% gross margin, clearly, because it's a licensing business model. But, maybe they're like 25% growth a year, 4.5 billion top line isn't enough. I want a piece of this. I want a piece of the
I'm sure SoftBank is gently on the phone going, what the fuck, guys? Can we get some more?
And, actually, this will require a significant investment from them, and this has been coming down. This is not an overnight announcement. This has been worked on for the last few years. This could take top line. That business line in itself could be many multiples of the existing business line. So obviously it will be less profitable. But
it's more a case now of who isn't building their own chip. And also, I think we're going to end up with who isn't generating their own power. All of the hyperscalers seem to be following the Chinese model and trying to build their own full stacks, which I think is a really, really interesting thought experiment. Harry, have you got anything that you wanted to poke in this one?
Yeah, it's strange that agreeing with Lomax, for them to sort of go away from that business model, and there seems to be a lot of competition for what they're doing. And of course, it's more than just it's an inference CPU. You've got all the networking. You've got all of the other stuff around the data center. So are they going to be doing anything else around that? Does this sort of threaten Intel, AMD more if it's on the CPU side?
Is Intel still around? Have they still got a business?
They've bounced back a little bit, but
Trump's taken a stake in them. Well, the US
Yeah.
government has.
Well, I think they gifted 10%, didn't they? Please help us. Please don't shut us down. Please look after us. Right. Well, last on the docket. Actually, well, before we get to our predictions, our news section, I want to talk about Innovate UK. So they're getting a strategic overhaul. A founder is now running the show at last, but will he be able to do what's needed? So first up, for those that don't know, what is Innovate UK? It's a government funding funnel for R&D predominantly, part of the UK's mechanism for de-risking and leveraging private investment. I was working out where it fit into the government stack. So you got Treasury, HMT, goes into DSIT, Department of Science, Innovation and Technology, into UKRI, UK Research, Harry, you'll have to step in here, UK Research and Investment, into Innovate UK, which is one of 9 councils. So that's the flow of bureaucracy behind the scenes.
UK has, I think it's 25 billion kind of R&D budget-ish. UKRI is about 10 of that. And then Innovate's
because
about
it was
1.
BEIS, wasn't it? BEIS became DSIT and 2 other quangos.
They can't keep it the same. They have to constantly relabel everything. But yeah, effectively, UKRI is the body that kind of funds fundamental research universities. So you then got all the different councils, so Biology Council, EPRC, Physics. So it's everything from quantum to bio to health. So that all comes out of, it's like university budgets plus infrastructure plus R&D spend, and Innovate's billion is focused on innovative SMEs and firms that are kind of taking that technology.
Right. And a year ago, exit entrepreneur Tom Adiola took the reins. Now, I think you've already said this, Harry, but he's allocating about $1 billion a year via grants, loans, knowledge transfer partnerships, and compute access. They've had their challenges. Most people will remember the Women in Innovation fiasco 2024. They had a 75K award awarded to 50 women. They backtracked, only awarded 25, 2 mil fell into an abyss, then apologized to the 1,500 applicants, and it was an unholy mess. It's obviously been noted as being slow, bureaucratic, often seen as a bit of a burden. Unreasonable, computer says no responses to many of the requests for support. And Adiola is now in charge, wants to shift from being a funding project into supporting more companies, make it more innovative, make it simpler and easier for companies to work with them. So can he succeed? Should governments try to pick winners? Can a founder mindset actually work in this environment, or will the civil service machine grind him down? Harry, you know this world. How would you tee this up, and where would you go?
Yeah. For a full disclosure, I'm on the Innovate UK Council, and actually I knew Tom before he took up the post, and he messaged me and invited me to kind of, I suppose, the inner circle to kind of help steer this. So first of all, like, Tom's fantastic, and I think at the end of the day, founders coming into organizations which remits are to fund via grants founders, it kind of makes sense to have some of that experience sitting in. So it's nice to see chief executive of major civil service department having a kind of a founder background, and I think Tom is definitely taking a fresh approach.
We're seeing more, aren't we? We've got Alex DePledge in there. We've had obviously Matt Clifford going in and out. We're seeing more founders and entrepreneurs touching deeper into government, and hopefully that will continue.
I mean, hey, they even invited me, so
Boom.
I think absolute mistake. But I think first of all, I know a lot about this area. I mean, actually, I was a recipient of an early Innovate UK grant. It was critical to kind of Xylo's success story. So they can be really, really useful things. I think the problem is, like, you've got the money's been very much spread very, very thin. Tens of thousands of grants, and then with AI you're just getting this like grant slop, so that they're having to kind of change for a number of different reasons. First of all, I think they were very broad, and I think now they're focusing around the industrial strategy. They're focusing around,
there's an alignment now, isn't there? We've all kind of all been kicked into gear, I think, a little bit with the 8 industrial strategies.
Yeah, it's like, hey, we invented the computer, yet we've got like no computing companies, right? Like the UK is unbelievably good at Nobel Prizes and fundamental research, and unbelievably good at giving it to the rest of the world to commercialize. So I think like the focus around advanced technologies, quantum, semis, and bio, for instance, is great, because actually then what's happening is more of it's focusing towards our strengths, and hopefully we're funding less what I would call iterative R&D of kind of old, medium-sized firms that are kind of getting, Innovate UK with some R&D tax credits, and they would have done it anyway. So I think it's good to focus on what we're good at, so that we can actually get that up. And then it's also just to have this kind of think, the other thing I think is bringing in, and I was, there the other day and they mentioned the word deal flow. And I was just like, to hear that kind of in a government agency was great. The organization needs to actually track the best companies. Why? Because you need to know what good looks like so you can benchmark everything. And two, hey, by going to a high growth company and actually supporting it, is it more likely to set up manufacturing in the UK, do more development? If it does raise that 200 million Series B round, is that now going to kind of be twice as many jobs in the UK? And therefore, the Exchequer collecting that kind of tax receipts. And it's less likely then, if it does get acquired, to keep a strong base in the UK. So I think, and at the same time, are they more likely to get that escape velocity? Because as we know, we've got to respect the power law. Most companies don't do very well. And, the one or two companies in our portfolio deliver, 90% of the returns. And I think just understanding that and setting up the system is really exciting. In terms of how hard it's going to be to implement, I think, they're thinking and speaking to all the right people, but the proof's going to be in the execution. And then finally, I think one of the simplest things, which, I said to do is like, most important thing I think for us is we don't want to waste founders' time. And there's lots of calls with really, really high failure rates, and biomedical catalysts for healthcare is absolutely abysmal. And you really want to make sure that you get the screening criteria right and you get to know really, really quickly. And we know that's really, really important in our trade, is that, if you mess a founder about, they end up spending, months in DD and then you pull out at the last minute. That's actually net negative to that company. So I think this idea of getting to quicker yeses and nos and actually having a prepared mind so you know what you're looking for is a good thing. And they're going to have to do this because they're going to need to actually assess the companies on fundamentals because of AI slop and grant writing. So, it's going to be hard, but I think, I back Tom. It's down to their execution at the end of the day. But what I've seen is, Tom works at pace. He's a proper founder, and it's going to be interesting to see how the civil service copes with that. But there's definitely.
Do you think he'll be given the latitude? That's what I feel is the challenge here. Will he be given the space and latitude?
I think look, founders are really good at kind of bashing their head against a wall until they get through, right? So if anyone's going to kind of make change, it's going to be a great founder. That they're used to kind of overcoming big challenges. We need to get the funding up. We need to get the funding up across the stack, and this is part of the mix. This won't solve it, but it's
it's going to be as multi-pronged affair, isn't it, Harry? It's going to be multi. It's going to be BB over here, a bit of grant over here, a bit of more private encouragement over there. Hopefully, some pension poking up here. So that whole pot will hopefully come to pass.
And it's people like us, it's founders, like, you can sit and be an armchair critic, but get involved, help.
Absolutely. Stop being such a cynic.
Be supportive, because I think that, I think a lot of the interactions I've had has been, they've been open ears, and it's great to see some of those changes that in various areas. I've been advising DSIP for a few years now, seeing some of those things actually starting to actually get through. So, you've also got to kind of roll your sleeves up, I think, sometimes, and go help out. It's a lot of good people, but it's a hard thing to kind of go against civil service.
Well, we are called Upside, so I'm loving your attitude. Lomax, before we move on, anything you wanted to add on this one?
No, I think it can only be a good thing. It's a hard task, but I wish them all the best.
We are going to try a new section in this wonderful podcast called Predictions, and we need a theme tune, or I'm going to hum a theme tune. Predictions. Lomax, what do you predict?
I just remembered that we're called Upside. This is not a great prediction.
Is yours misery? Are you predicting misery?
Are you 100% gold?
The revenue is not going to. My thinking is that the revenue is just not going to come fast enough to justify the capex of these hyperscalers. The big five hyperscalers, Amazon, Microsoft, Google, Meta, and Oracle, spend over $602 billion on infrastructure this year.
They won't though. Won't.
They will, Dan, and that's like 33% up from last year. And so, and I just think, to put that in perspective, it's just the Amazon's capex is greater than that of the entire US energy sector. It's just insane. So I think, between now and 2030, there's sort of 2 trillion of AI related capex. And I think if you look at where the revenue is today, you total OpenAI, Anthropic, and enterprise AI, I don't know, at best you're at a 100 billion, and then you take
Oh,
that
I
back.
think double that. I'm pretty sure OpenAI was looking at 150 by 2030 or something like that.
Was
Yeah,
it
but I
what Lomax? You hear? One of my friends is a hedge fund manager, and he was saying that a lot of this has been accelerated by this kind of depreciation rules that Trump brought in. So effectively, they can depreciate 100% of this kind of on day one. So if you're high cash flow, it's effectively tax back. And I don't know how much that's actually
How's that
hugely
possible?
accelerating this infrastructure build out, because you've got this kind of 100% depreciation like
on day one.
accounting thing that they brought in. And I think the thing that breaks it though is, yeah, like you say, is Iran and maybe the Saudis like not being able to participate.
I can't see how. There's just too much friction here. Okay, so what's the prediction? The prediction is revenue's not going to move fast enough to justify the capex. Is that the
Yeah,
prediction?
the payback just won't be there, especially when they need to keep ripping out these GPUs every 2 years now and putting them back in. It's just so people will realize that, and people will realize they're over their skis, and we'll have a general cooling off. It's not a revolutionary prediction, but I think it's just still every time I go.
Well, it's our first week of predictions. I think it's a very solid prediction.
Yeah, but when I go through these numbers, I know Mads is not here this week, and he's much more of an optimist than me. But I just think we're getting over our skis.
He's coming more down our path. Did you notice last week he's coming down more this way? Is that, hang on a minute, we are now moving out of free cash flow and into debt. We've got to think this stuff through. Harry, what was your prediction?
I think you're seeing some of that heat coming out of the market. That the last month or so, you've seen a real pullback, across the board, and a big rotation. Like, I think what I'm seeing at the moment, if you look at the 52-week prices on the kind of the Mag 7, like you've just seen this kind of huge rotation. Microsoft is pretty much down at the lows on its 52-week range. So is Meta, but Google is still is doing strong. Apple's doing really, really strong. So I kind of feel like we're seeing the disruption of the Mag 7. And then you've got the IPOs of SpaceX, Anthropic, OpenAI. So I kind of feel like Microsoft, Meta potentially going to be displaced. I think potentially if those two things come in, like you're going to get this kind of rotation in these other stocks. And, are you going to see like this, fragmentations? I'm kind of, to be fair, in April, I reduced my positions in Microsoft and Meta just for these reasons, because I just feel like, they don't really have a moat, or as much of a moat as I think, say, look at Google. Google's all the way through from one of the best AI teams in the world. It's Demis. Demis is a god. Yeah. All the way through to kind of the hardware. They're, training Gemini and the first TPU.
And they have the strongest distribution. By a country mile, I would argue.
And then you've got, Apple, and you've got these kind of M5 kind of chips, and being able to do, inference on your actual device. I won't talk about Tesla because I'm not including it.
No, I'm very happy not talking about Elon. That's fine with me. Yeah, I saw that that Siri is now going to aggregate whichever model you want to use. So they've culled their unique arrangement with OpenAI, which I think is the way to go. I thought they were going to get fully into bed with the on-device Gemini, but we'll see. Maybe they've worked out their own models. I imagine so on the 5.
And the last thing, sorry, is that all those IPOs probably won't happen if this Iran thing doesn't sort itself out.
Yeah, that's a solid prediction.
Why are you going to IPO if and I think if things are,
inflation hits 4% in the States, which it's predicted to do.
Yeah, that's going to be crushing for equities. So you're seeing that already, right? I mean, just looking at today, sort of 2% down across the board. So last week's been all in the red. So
loving it.
Don't know where that's going to go.
Just to be extremely dull, my prediction is in exactly the same camp as both of yours. So my prediction, what I found fascinating this week is I was looking at how the hyperscalers are projecting revenue. So I was just picking on Anthropic just as an example, because there was a big discussion this week about how they did 6 billion in February. I don't know if you saw this. And I was like, they didn't do 6 billion in February. And they actually didn't. What they've done is they've got 6 billion added to their run rate, which basically, if it was 6 billion in February, they would be predicting 72 billion in ARR. So it's 6 billion to the run rate. It's around 20 bill. doing extremely well. I mean, we're still talking buckets of cash here. I'm not trying to be demeaning in any way. However, how they predict and project their revenue is they take usage spikes from that month and then forward plan 12 months. So it's all these people experimenting and spending gazillions on tokens. And then I was looking at what other fact did I read? It was 8 of the Fortune 10 companies are all Anthropic customers. But you don't have to scratch a little bit below the surface to see that some of them are the low cost, low spend. Okay, you got somebody in the 8 of the 10 using the tech, but it's just not the volume that people think. There's going to be, I think, a reckoning. And I think we're going to start seeing how these nonsense capex spends, where I'm not with you, Lomax. I think a lot of this capex just can't happen. Just throw energy and war into the pot and they can't happen, let alone planning and all the other frictions that we're going to see. So I think my prediction is that people are going to start to wake up to how these revenue lines are pushed into the press and how they're absolutely nonsense. Last thing before we close off on this, interestingly, 79% of OpenAI customers also pay for Anthropic products. So everybody's buying everything and trialing everything. And I think that's just going to stop.
I think you're going to start. I think I'm not a very good representative of the general population, but I think you're starting to sort of just, you've been trying everything. You're starting to sort of get your kind of tech stack locked
That's
in now.
right.
And I've been, I got rid of OpenAI a while back now. Anthropic, Cursor's now gone. So you're starting to and it's really like, Anthropic and Google for me. The other thing I thought was interesting is kind of how they set their prices and forecasts. It sounds very much like how the energy markets in the UK work, where 10-20% of
get the gas leverage and
let's just set it off the gas price, and that's what we should all get paid. Anyway,
yeah, I'm going to go with that. Deal of the week, Lomax, quickie. Deal of the week.
Deal of the week is Nathan Air Street. It's a fund.
Good for him. Good for him.
He wrote his solo GP raised Air Street 3, I think it is 232 million.
Yeah.
So good on him. He's been long on AI ever since he set up the fund. So good for Nathan.
It's great to see. It's great to see kind of new GPs coming in and raising that kind of capital.
He's solo as well, right? Yeah.
Solo.
Mine was Granola. I love the fact that Granola becomes the latest UK unicorn. I love Granola. I think it's a bloody awesome toolkit. Harry, did you have a deal of the week?
I think mine was this lace lithography. I can never say lithography.
Everyone's got one of those words.
Funny enough, like we've looked at a few of these kind of companies, so I won't say that word again. But effectively, what they're trying to do is get below this kind of EUV kind of 13.5 nanometer limit. So effectively, when you make chips and you put the designs into silicon, you need a really, really small short wavelength of light to make these tiny features. And effectively, we've kind of Moore's law in terms of transistors is stopped now because, we can't get past this kind of sub-nanometer resolution at the transistor level. I wanted to send this to Alex in our team. He's got a PhD in optical physics, but I didn't get to. So I've done my best to try and explain it.
Yeah, I love it.
Interesting, great. Whether it's
Bring
a competitor to ASML.
And that's, what was this, Norwegian? Where are they? Where's Leicester?
Norwegian deep tech startup company.
Gentlemen, loving that. Loved our chat. Thank you so much. And I'll catch you all next week.